Apollo's been with Dimensional for the past 20 years, based in Santa Monica. And prior to that, he taught at the University of California. He received a PhD in economics and finance from UC Santa Barbara. And of interest to us in Michigan, Apollo holds a BA in economics from Michigan State University, go green, where he competed and coached water polo. And so he knows Michigan winners. He now lives in California, so smart man. So welcome, Apollo.
Well, hi, Jeff. Well, thank you so much for the invitation to be here. And it is interesting because, I on my desk, for the longest time, I had my Michigan State water polo hat from the time when I played and I coached there. It's absolutely worth maybe even saying congratulations to the Michigan fans, because it was a great week for them. But it's interesting to hear also that we're both celebrating 20 years.
Right.
I've been 20 years with Dimensional. You founded Grand Wealth 20 years ago, so congrats on that. And excited to be hopefully Thanks for inviting me.
Yeah, well, thank you. And this is, again, one of a series, and we'll do this on a quarterly basis throughout the year, hopefully going forward. So, we're going to cover relevant topics, kind of current market, some of the questions that we're getting. But to kick us off, stocks did very well in 2023, hitting record highs in December. S&P 500 ended the year up over 20%. Somewhat fueled by the so-called Magnificent Seven stocks.
Yeah.
So just wondering if you can explain the performance of stocks in general and put some context around the stock performance.
Yeah, no, absolutely. And it was a very good year, as you pointed out. And in fact, there are different measures of the U.S. market. And if you watch the news or pick up a paper, you would see there are typically about three different metrics that they're being used by the media. The first one is the Dow Jones Industrial Average, and the Dow Jones Industrial Average is certainly a very well-known metric of the market, and that was up about 13.7% last year. So really nice growth in there. The second one is the S&P 500, which is the largest 500 companies in the U.S. stock market, as opposed to Dow Jones that only has about 30 stocks in its composition. And to Jeff's point, it was up about 26.3% last year. So really nice return. And folks, just to keep in mind that the long-term average in the U.S. stock market in the S&P 500 has been about 10% per year. So last year we had a really nice growth, more than twice the long-term average. But there's another metric in the market that's called NASDAQ, which represents all the stock that have chosen NASDAQ as their trading venue. And if you look at NASDAQ, what's interesting is that it went up over 44% last year. So the first thing that to Jeff's point is that it's really good to acknowledge that we had a good year in the market. Whether you look at the Dow Jones, the S&P, NASDAQ, all the metrics of the U.S. market, they really had a really nice growth, and particularly after 2022. I mean, Jeff, you remember at the end of 2022, there was quite a bit of pessimism in the market. We had a negative year in 2022. And then as we started last year in 23, we had a pretty big financial crisis with echoes of 2008. And then we had the government almost defaulting on its debt. The Fed continued to raise rates. You had the Hamas attack in the fall. So there are a lot of things that one can say, wow, they're really negative for the market. And yet we did see that we had a positive year, which speaks for this idea that I know Jeff and I share of being diversified and being disciplined. So the first thing to note is that it was a very good year for the markets. But it is interesting because when we look at the S&P 500 and you see, well, it's up 26%, that's phenomenal. And yet S&P is not a homogeneous organism. In other words, it doesn't have, it's not that every single company there in its composition has the same performance. The S&P, the way it's built is to look at the performance of these companies, and it takes account of the size of the companies. The larger the company in terms of what's called capitalization, which means the number of shares of ownership multiplied by the price of each share, that's called the capitalization of value of the company. And in the S&P 500, there's a greater emphasis on the larger companies. And the largest 7 stocks, the largest 7 companies in the S&P 500 are the companies that become known as the sort of the Magnificent Seven. And these are the large tech stocks that we all know about: Apple, Microsoft, Google, Tesla, Facebook, Amazon, and NVIDIA. And these 7 companies did quite remarkably last year. If you look and you pull these out and you look at the performance of the Magnificent Seven, what you see is Jeff, something quite remarkable. On average, between the 7 of them, they went up by 105%. It's a remarkable performance. They went up more than 100%. They more than doubled in value on average between the 7 of them. And what's so interesting is that if you look at the remaining S&P, let's call the S&P 493, it's the 500 minus the 7, what you see is that on average, it went up by a much smaller, relatively speaking, 15% or so. So it is quite interesting to see that last year, the market without the 7 stocks, it did closer to the historical average, but these 7 stocks really had an amazing performance. So when we look at these 7 stocks, and what's interesting, they leave a hole in the S&P, and it could be actually a pretty significant hole, because when you look at these 7 stocks, and you account for them as part of the S&P, what you see is that these 7 stocks, these particular 7 companies that I mentioned, account for about 28% of the value of the S&P. In other words, 28% of the performance of the S&P is attributed to these 7 companies, which is quite a bit if you ask me. 7 companies out of 500 account for about 28%. But what's also so interesting is that if you look at NASDAQ is much more concentrated. 49%, almost half the value of NASDAQ comes from 7 companies. 7 companies drive roughly half the performance of NASDAQ, incredibly concentrated. And if you look at the entire U.S. stock market, which is the S&P, the largest 500 stocks, plus another 2,500 smaller companies, that percentage decreases to 24%. And in a global portfolio, which is most likely what modern investors have, the same exact stocks are owned at about 15%. So I think that, Jeff, what's been really interesting to see is this divergence in performance that is caused by the concentration or the diversification related to these 7 stocks. And quite often, like what you see in this global allocation, that you have these stocks, they were part of your portfolio. It's just not as concentrated as NASDAQ. And what it basically means is that if you look at NASDAQ with a 49%, last year it had a phenomenal performance. As I said, 44% in 2023 performance for NASDAQ, because these 7 stocks did so well. Boy, I can't even circle here. But then if you look just the year before, in 2022, the same exact 7 stock, the same exact NASDAQ that was concentrated in those stocks, it was down about 32%. So a huge swing from one year to another. Whereas if you were in this more diversified global allocation, where you still have these 7 companies, but in a lower percentage, what you see is that the range of outcomes is very different. In 2023, you wouldn't have gone as much as high as 44%, but last year you would have actually had a much lower drop in value. So to me, in my opinion, it's a better way to go, because if you look at 22, 23, and you combine these 2 years, on a cumulative basis in the Nasdaq over these 2 years. What you see is that you would have had even after this 44% up, you would still be underwater by about 2% or so. Whereas in this a globally diversified portfolio that's more diversified, you'd actually be up about 1%. So not only that by diversification, you reduce the range of outcomes with your money, but at the same time, you actually get better results as well. So it has been an interesting, just a really interesting year to look and see how different it was and the benefits of being diversified as well as disciplined. And the last thing that I'll mention here on the Magnificent Seven, Jeff, is that whenever people look and say, listen, it's been a great year. So this year it went up by about 105%. So boom, these stocks have done incredibly well. These are only the Magnificent Seven. And you say, well, in 2022, they did phenomenally well. And yet in 2023, they did well. In 22, it was down 45%. The one thing that I have to say is that if people are saying, well, I'll take the 45% down if I'm going to go up 100%, there is a bit of arithmetic involved in investing. If you had taken $100 and invested in these stocks at the beginning of 2022, and you lost, just to make the math simple, let's say 50% of the value of the money, then by the end of 2022, you would have $50. So if you now start 2023 with $50 and you want to go back to where you started at $100, going up 50% is no longer sufficient. You actually, to go from 50 to 100, you have to double your money, meaning that you have to go up by 100%. So when you see these big numbers here, it went up 105%. Remember that after a very steep drop, there's a huge climb back to recovery. For example, you take a company like Tesla. Tesla went up 101% last year in 2023, which should be like, that's amazing. We're just so good because it's more than it dropped in 2022. And when you look in the combined 22 to 23 on a cumulative basis, Tesla is still underwater by almost 30%, even after a year like that. Because when you have these huge drops, there's a very long road to recovery. So I have to say, it's been interesting to look at these companies. Amazon, the same, up 80%. It's still on the water. Google, up 58% last year and still on the water. So you can go through all of these different Magnificent Seven and see that, some of them are doing really well. And particularly you look at NVIDIA, that is the one stock that just, shut the lights out. But if you look at the S&P 500, just a broad measure of the U.S. market, it basically is somewhere in the middle, outperforming 3 out of the 7 Magnificent Seven. So long story, it's a great illustration of sort of the power of the ideas that Jeff has been putting out. And it's also an illustration of another concept that Grand Wealth applies, which is that in years when something goes up in value, like we had energy went up and up in value in 2022. And one of the things that advisors do is pay attention to whatever goes up in value, and they trim some of those gains to rebalance the portfolio, and they buy whatever went down. And it turns out that technology stocks, by being down and by rebalancing, it allowed you to capture these great returns that they had this year. So a lot of interesting lessons. But if you look at the market last year, again, very interesting. Sort of the market as a whole, minus the 7 stocks, was much closer to the long-term average, whereas these Magnificent Seven just set up just a gangbuster year.
Yeah, very amazing. And I guess really reiterates the idea of diversification, reducing volatility, and volatility over the long run being beneficial to returns. Shift a little bit, and I do want to remind people there is the ability to submit questions in the Q&A. we'll be able to see the questions. The other participants will not. So we will be able to address specific questions if you want to submit them. But one thing we've heard from clients is U.S. market returns have been higher than international returns for some time now. And there seems to be some headwinds that have been the cause of that in international markets. But is there still a benefit of holding global stocks, international stocks in a portfolio?
Yeah, absolutely. And I think that last year it was an illustration of this. If you look at 2023, more of a global basis, not necessarily only in the U.S., and just look at stocks as a whole. The U.S. market, as we kind of pointed out, did quite well. It was up about 26% or so if you look at the S&P 500. And yet, when you look at international developed markets, what you see is that it was up roughly about 17% or so. So certainly not as much as as international developed. And then you had emerging markets. There was up, if you look at a fund, it was up about 15%. The index was down a little bit lower than that. But international developed and emerging markets certainly did not provide investors with the same returns as the U.S. And with that being said, there's still really good returns. International developed and emerging markets, they're still above their long-term average, but not as much as the U.S. So the first thing that's interesting, it was interesting to me, is that international developed and emerging is basically it's a label that covers just a number of international stock markets, individual stock markets, and not all these markets behaved exactly the same. So when you look at international developed, for example, there are stock markets that did better than the U.S. Italy, for example, Italy was up about 27%. And then you had Spain that was up about 32%. I'm sorry, this is 37% and then 32%. So these markets did better than the U.S. So in that respect, you can say, well, we had stock markets abroad that did much better than the U.S. But there are also others that didn't do as well. It's worth pointing out that Finland, for example, was down about 6% or so. And then you had Hong Kong that was down about 15%. So we had a range in international developed, and the U.S. was not the best performer. And then we also had emerging markets countries that, if you look at these MSCI indices, you see that some of the best performers were Greece. Greece was up about 50%, almost twice as much as the U.S. And then you had Hungary that was also up about 50%. So you did have international markets that did, again, significantly better than the U.S., but you also had some that didn't catch up, and you had Thailand that was down about 10%, and you had China that was down about 11%. So the first thing that I would tell folks is that when you look at international investing, not every market moves in lockstep. And even years like where, as a whole, the U.S. might be better than international developed and emerging. Within those, there are going to be countries that perhaps would do better than the U.S. But I think there's, Jeff, there's a much more intuitive way to look at it. I mean, today in the world that we live in, you can kind of look and say, well, do I want to buy just U.S. companies that might be selling abroad, or isn't that enough to diversify? And in my opinion today, it is not just about what we sell to foreigners, but what is being sold to us. And in that respect, we are not investing in countries as much as companies. And these companies have a global reach. The same way that the U.S. sells abroad, these companies sell to us. And you're in Michigan. I live next to a plant in Lansing. And what's interesting is that if you look at cars, and if you say, well, let's just put money in the U.S. and invest only in the U.S. because it's done better, it's a little bit on an intuitive basis as saying that I want to, buy, let's say, car companies in the U.S. And the U.S. is certainly the biggest stock market in the world. If you look at a world map drawn based on the value of these companies, Ford, GM, Coca-Cola, McDonald's, Facebook, Apple, the U.S. is about 3,600 different companies that amount to about 59% of the value of all stocks around the world, of all companies around the world. But there are about 9,000 others that are abroad. They're in over 40 different stock markets. And the question is, how much and should he be putting money into these other countries? And as I said, if you're just going to limit yourself to the US, it's saying that, yes, I do think that these car manufacturers, Ford, GM, Tesla, are worth investing in. And that's great because they're great companies. They make great products and they sell abroad. On the other hand, if you go look on the streets, you don't see just GM, Ford, and Teslas, but you also see some German cars. You see some BMWs and Mercedes. And not only that, but great American brands like Jeep and Chrysler. They're owned by an Italian company that trades in Milan. So, you know, if you want to own those brands, you have to do international investing by buying Italian stocks. There are the Japanese stocks and the companies that we know well, like the Ford, Toyotas, and so forth. Not the Honda, Toyotas, Land Rover, and Jaguar. They're owned by an Indian company. Not by the Brits, and even Volvo is owned by a Chinese company, and you now have the Korean shops kind of making inroads. So ultimately, the main intuition that I want to send, Jeff, is that when you think about investing in the U.S., it's saying I want to own Ford and GM. But you know, while it makes sense to absolutely own Ford and GM, shouldn't one also consider BMW and Toyota? Because they're certainly selling to us as much as we're selling abroad. So that's kind of the intuition. We're buying companies, and if it's worth considering Ford and GM, why not consider BMW, Toyota, and Jeep for that matter? The reason that most people are now looking at these the U.S. market and saying we should put more money is because the U.S. has done really well, not just last year, but in fact, if you look over an entire decade, 2010 to 2020, what you see is that the U.S. has done really well. And if you now rank all the countries from 2010 to 2020 for those 10 years, what you see is quite interestingly is the U.S. was not the best performing country. That goes to New Zealand. But the U.S. in yellow was the second best performing country. And I think that's why a lot of people right now are saying, well, let's put more money in the U.S. because, look, it's been 10 years when we really significantly outperformed international markets. And for an economist, one of the questions is, how consistent is that outperformance? Do we see that in every single period? And yet, when you go back just a single decade from 2000 to 2010, do we see the same pattern? And interesting enough, we don't. In fact, the U.S. still in yellow. It's nowhere near close to top, but it's all the way to the very bottom. For an entire 10 years, the U.S. was a really a lower standing in terms of performance. And nobody was saying, let's put more money in the U.S. when all the other countries were really holding up the portfolio. So again, it's interesting to see that there's a recency bias that we see that the U.S. has done well for the past 10 years. And we assume that's always been the case. Not necessarily. And in fact, we have data not only for the last 10 years, and here I'm looking at all these international developed markets, and we see that indeed the U.S. for those 10 years has outperformed, but we have data going back to the 1970s. And we wanted to ask the question, well, how consistent is this decade outperformance by the U.S. market, which is in that green color? And if you look in the 70s, international markets significantly outperformed the U.S. In the 1980s, it was exactly the same thing. And in the 90s, we had the technology stocks that had that remarkable performance, and the U.S. Market just went up really nicely up. But then we know what happened afterwards. It was the hangover. It was the 2000s where for an entire decade, the U.S. stock market was negative. So when I look at the intuition, it tells me that, yeah, perhaps it's worth having some international stocks. When I look at the data, it's telling me that it's nice to see the U.S. sometimes outperforms. I just don't see it consistently enough to say, let's move all the money to the U.S. And the last thing that I'll say, Jeff, is that, when we're talking about investing in the US or abroad, we're not saying that put all the money abroad. If you use this map as a starting point, the largest chunk would go into US companies. And in your allocation, most likely the stock market with the largest percentage is the US market. And the next largest one after that is Japan. And it's only about a tenth of the value of the US market. So we're talking about a diversification piece in international market where the lion's share is are the US companies. So you're not really missing out on those. It's just more of a diversifier. And it's so interesting because in December, I had some investor meetings in Tokyo. I was actually in Japan. And it was interesting to see how the folks that I met with were talking about a reluctance by the Japanese investors to put money in the market. And the reason for that is because in the 1980s, the Japanese market did extremely well. The Japanese market was doing everything right. You had the Sonys and you had the Hondas and the Toyotas selling everything and everywhere. And a lot of folks basically start putting money in the market. And in the 1980s, by the time we got to 1990, what's so interesting, Jeff, is that the U.S. stock market was not 59%, but it was in fact about 30%, whereas the Japanese stock market was 41%. And imagine that you're a Japanese investor in the late 80s, early 90s, kind of thinking of where am I going to put my money? Well, if you have your home country that has done so well, it seems like it's unstoppable. It seems natural, like I'm just going to put money in Japan because that's unstoppable. It's doing so well. It had great performance over the past decade. So it makes total sense. And yet again, the lesson here is not that that the U.S. is going to go up or down relative to Japan or it's going to go down in value. Not at all. The main story here is that you can have a good decade and still there's good reason to diversify because you never know what's going to happen. And a lot of these Japanese investors, again, they got a really bad taste because for the past 30 years, as I said, the Japanese market went from being 41% to being 6%. And by no means am I implying that's going to happen to the U.S. I just think it's a good idea not to let the last decade be an indicator of what's going to happen over the next 10 years.
Mm-hmm. Again, good lesson on diversification and avoiding recency bias, just looking at what's happened of late and following that trend. We do have a question that's come in. This could probably be a whole topic for a future webinar. So if we want to put some of this off, but a question on AI, which is coming up more and more. Markets are cyclical with a history of regressing to the mean. Given this, do you think the application of AI to analysis will be capable of teasing out more effective investment strategies? So what, I guess, the impact of AI on investing?
Yeah, no, it's certainly a big topic, and I think AI, the way that it is shaping up, and what really AI is doing is trying to identify some trends and patterns in the data, and then from there try to find what is the most likely, for example, word in a sentence. You identify these patterns, and then based on all this information that you feed in the machine, there's an output, and that output is sort of what is the expected next word, for example. What's most likely to be the word that would be in a sentence, and it certainly made big inroads, and people are looking and saying, well, how is this impacting investing? And I think it's a very legitimate question. The way that I look at it is that the Dimensional has perceived the stock market in a way to be the ultimate AI, because for the past 30 years or 40 years, what we've kind of suggested is that when you have a mechanism that takes all the information, process it, it creates an output. And instead of being a word in a sentence, the output that the market creates is the price. You take all this information, put in a hopper, and there is something, an output that the market creates, which is the price. So to us, in a way, the market has been the ultimate AI. And with the advent of these new technologies, what I think it's happening is that the markets are becoming even quicker and quicker and quicker to process and analyze that information, which basically means that the advent of AI is going to make the markets even more efficient than they used to be, which by implication means that it's going to make it incrementally harder for anybody to somehow be able to have an advantage relative to everybody else in the market. In other words, I believe that AI in investing is going to make the markets even more efficient. They were efficient to begin with, but now you level the playing field. Everybody has access to this information. Everybody has access to these models, and it's going to make the markets even quicker in terms of analyzing and processing information. So the one result of that, in my opinion, is going to be an even further demise of any strategies revolving around stock picking or market timing, because it's going to make it so much harder since everybody has access to these technologies and the data. So to me, the way I look at it is the market is been an AI processing machine for a long time. Now it's even more efficient, and the strategy that I think that we've been suggesting, and what I think what we share with Grand Wealth is this: the idea that don't go around and try to say that I have a better mousetrap, but rather look at everybody processing information and market as the ultimate AI. It has even more validity with the advent of these technologies.
No, that's good. Good. And yeah, I don't think we've ever thought that we have a bit of information that nobody else in the world, in the marketplace, knows about. So very consistent with the way we've always thought about investment markets. Wanted to shift over. We've talked about stocks. Let's shift over to bonds. And bonds also had, at least relative to 2022, especially, a much more positive year. But I guess, what can you do to explain the bond market?
Yeah, so the bond market it's been quite interesting, because the bond market can be delineated on a number of factors, and one of them is the maturity or the length of the contract of the bond. So let's just take a step back and look at bonds, because I think a lot of times bonds can be boring or intimidating. So let's just make a little bit of sense out of bonds. Bonds are a form of borrowing. The U.S. government, other governments, companies, they need to borrow money. And instead of going to the bank and taking out a loan, they come to us as investors and say, Jeff, you have $1,000. If you give me the $1,000, we will write up a contract. And in that contract, we specify an interest rate that you will receive. And then we also specify for how long you will receive that interest rate. And at the back end, we will give you the principal back. That's what a bond is. It's a form of a loan where along the way you get interest payments that are spelled out in a contract. And then at the back end, you get your principal back. So in that respect, it has a little bit more certainty than the stock market, because the stock market, you have no idea what you're going to get. But with these, that interest rate that is put out in the contract, and it's a very enforceable contract. You can take a company into bankruptcy if they don't make payments on some of these bonds. So what's been interesting in 2022 is that let's just put some numbers out there, is that if you look at the early 2022, and I'm going to go to 2022 just because it was an interesting year. In early 2022, let's say you lend the money to the government for about 5 years, you would receive about 1% in interest on your money. So that was kind of the prevailing rate in early 2022. But by late 2022 and early 23, what happened was the newly issued government bonds were no longer paying 1%. The investors are saying, I'm not taking 1%. Government, you have to pay me more. And they just got, let's say, to about 4% in interest rate. And the reason that is interesting is because when these interest rates change, If you had this 1% bond that you bought early in the year, you can just hang on to that bond, get the 1%, and you're fine. You're not losing anything. You're fine, because the government is very likely to pay you. However, you now look and see, well, the new ones are paying 4%. Perhaps I need to make 4% of my money because mine only pays 1%. So now you're trying to sell your bond so you can buy the new ones. The trouble is that because your bond only pays 1%, you're not going to get the full value of what you paid for. And in fact, one of the fundamental premises in bond investing is that when interest rates go up, and that happened in 2022, the value of the existing bonds goes down because if you're trying to sell them, they're not worth that much. And there's a relationship link there that is called duration, which is basically how long before you get your money back on that bond. And when you multiply the duration with the change in the interest rate, you get a sense of roughly how much money you stand to lose. So in 2022, if the interest rates, let's say they went up by 3%, and you had a 1-year bond, a 1-year duration bond, then if you multiply 1 by 3, you see that you stand to lose about 3% of the value of your bonds, which is not pleasant. It's just not devastating either. Now, let's say you have the 3% increase, and now instead of a 1-year, you have a 10-year duration bond, which is much longer. And at that point, if you now multiply 10 by 3, you see that you would have stand to lose 30% of the money in your bonds. So one of the really important characteristics of the bond, it's what's called the maturity. In other words, how long before you get your money back. And the longer term bonds, they're much more exposed to the risk that if interest rates go up, you're going to take a bigger hit. So because of that, one of the characteristics that is really considered by investors is the maturity. So last year, if you look at maturities, it turns out that whether you looked at a 1-year, whether you looked at a 3-year, 5-year, even intermediate government bonds, they all performed roughly the same. They went from about 4 to 5% in return. So it was a good year, it was a positive year. And that's why we actually use this maturity as being one of the determinants of what type of bonds you want to own. The second one has to do with what is the credit quality. In other words, how creditworthy is the issuer. And the U.S. government has never missed an interest payment, never missed a principal repayment, and it's considered to be a really good bet. Because of that, it's sort of like, not risk-free, but it's as close as you get. And then you compare that with some companies that perhaps carry more uncertainty to them. And the ones that carry more uncertainty, they actually pay investors a little bit more. So to give an example, if you look at an intermediate, let's say 5 to 10 years government bonds, and you compare that with the 5 to 10 years intermediate corporates, extended quality, the way it's called, the difference was that you got about 4.5% for the government bonds, and you got about 9.5% for these corporate. And that's a choice. That's something that Jeff and the team would basically look and figure out what are the right bonds for your situation, your circumstances. Not a right or wrong. There's not one single optimal bond for everybody. But the long story is, Jeff, is that last year we saw bonds across different maturities performing quite similarly between 4 and 5%. And we also saw bonds that were a little bit lower credit quality, still investment worthy, actually perform quite a bit better than the government bonds for the same intermediate term maturity.
Now, Paulo, when we go through a situation like we did in 2022 with interest rates going up and the value of bonds going down, for someone holding an individual bond that they plan to hold it to maturity, they may not be too concerned about a temporary reduction in value if they plan to hold it and it's high quality and it's going to pay all of its interest payments and pay out at maturity. For someone holding a bond fund, it maybe just feels different when they see the value go down. So can you explain a little bit the difference between holding an individual bond, holding a bond fund?
Absolutely. Absolutely. So when you're holding an individual bond, that you purchase that bond and you own that bond, and those payments, the interest payments come directly to you, and then you do whatever you want on that bond. So one of the options that you have as an investor is you can go buy these individual bonds. So the good news is that if you own these individual bonds, to Jeff's point, then you're not exposed to selling them. If you don't want to sell them, you don't have to sell them. And you can just hang on for it. If you own a bond fund, then the fund it buys all these bonds. And what the fund has to do is every single day see what is the value of those bonds, whether you sell them or not. So in the case, let's say 2022, if a bond fund had the 1% bonds, and by the end of the year, it still had the 1% bonds, but it just kind of hang on to them. The value of the 1% bond had to be reflected at the new value, the fact that it's a lower value, even though you still own it. So the bond fund has something called net asset value, which looks at what is the value of all the bonds that it holds. And that net asset value actually dropped. And that was certainly a situation where a lot of people saw the losses. And the bond fund at that point, most likely what they would do is sell those bonds, might as well sell them since they were devalued, and buy the new higher paying interest bonds. But again, what you saw was a loss. Now, what's interesting is that the opposite is also true. If you have a change in interest rate in the opposite direction, and now instead of the interest rates going up, they go down, then you would see the opposite effect. So let's say that interest rates go over the next year or so, let's just say they drop, just for the argument, let's say 2% drop in interest rates. Nobody knows what they'll be, but just to kind of make a point here. And if you have, let's say, a 5-year bond in duration, then because the interest rates drop, the opposite idea applies, that now you own bonds that are paying more than the prevailing interest rates, so they have a greater value. So you would see a pop in the net asset value, even if you still hold the bond funds. So the ultimate idea is that if you own individual bonds, one can point to that benefit, that he can just hang on to them, don't sell them, you don't see losses. I'm not convinced that that's a big benefit for two reasons. One is that you do actually have a cost. It's called an opportunity cost. You could be making 4% and you're only making 1%. Well, that's an opportunity cost. So yeah, you can hang on to your 1% and see you have no losses, but you do have an opportunity cost, and that could be big. And over the long run, you might be better off taking that loss and buying the higher paying bond. And the second reason is that if you buy individual bonds, you really need to know which ones to buy. You need to have enough assets to diversify across different bonds. And you also have to have enough assets so you buy them at a good price. It turns out in the bond market, as opposed to the stock market, the larger the purchase, the lower the cost per unit. It's like going to Costco. There's a difference between going to your neighborhood 7-Eleven or a little grocery store versus buying from Costco. It's like when you buy them in bulk, when you buy in large quantities, and we're talking about lots of about $2 million, the price that you pay, that you get for these bonds, is very different than if you buy like little pieces of that, like 1,000, 2,000, 3,000. So it does matter in bond trading, the volume that you have. So when you put everything together, the convenience of the bond fund, the fact that you have a professional choosing the bonds, the fact that when the dividends come in, that the interest gets reinvested, and it's all relatively inexpensive. I mean, a bond fund is 0.1%, meaning like it's like 10 cents out of $100. It's quite inexpensive to kind of own one of these. I'm a big fan of being in this more diversified, professionally managed bond fund rather than own individual bonds. But in some cases, I can't say that it never makes sense. In some cases, it might make sense for some individuals to own individual bonds.
Yeah, good. One other question relative to bonds. You're talking about government bonds, in the 4% range. Certainly, you can get corporate bonds, even investment grade, at higher interest rates. But in an environment where you can get a money market yield at 5%, or CDs paying upwards of that, can you address the relative attractiveness of holding bonds in a portfolio relative to cash?
Yeah, for sure. And that's been the big story last year, is because we did have a pretty high rates into what's called CDs and money market funds. So let's just kind of make some sense of what happened in 22 and compared to 23. So if you look at the maturity of the bonds, which is the length of the contract, in 2022, and I'm just going to use some generic numbers here. If you had looked at the interest rate, the relationship between the interest rate and the maturity, which is also called yield, at 30 days, if you had lent the money to the government for 30 days, you would have gotten something, let's say, in the order of about 1% for your money, just in that neighborhood. And if you had lent them the money for 1 year, given that it's a longer time frame, you would have gotten paid something in the order of about, let's just say, 2.5%. And that was kind of the rate that you would have gotten on a 1 year. And then if you said, okay, I'll do it for 5 years, you would have gotten paid even more at about 3% or so. And then if you look at 10 or 20 years over the longer term, you would have gotten paid about 3.5%. So this connecting all these dots gives you something that's called an yield curve. And a yield curve is just a relationship between the maturity of a bond and the interest rate that you get as an investor. And it's normal, because that's kind of what I expect. If my money's locked up for longer, I should expect to get paid a little bit more. Now, when it comes to 2023 and what we saw last year, it was something that was quite different. And what we saw last year was that the bonds, there were 30 days, they were actually paying something in the neighborhood of about 5.5%. And then if you looked at 1 year, instead of paying more, they're actually paying less. It was about 5%. And it's just a bit of a, strange thing, but that's what happened last year. And then if you looked at 5 years, it was about 4%, and it was roughly the same if you looked at a longer 10 or 20 years. So what we saw last year was a bit of an anomaly, which is unusual but not unprecedented, when instead of having this normal shape, we have something that's called inverted yield curve. And inverted yield curve means that again, it's something that doesn't happen often. It happens every once in a while. And it's this anomaly that the shorter term bonds, they pay more than the longer term bonds, which is, again, it's not the norm in the market, but it does happen every once in a while. And it turns out that these CDs and money markets that we're talking about, by their nature, they have to buy bonds that are in the 30 to 60 days range. And that's exactly the type of bonds that pay the most, 30 to 60 days. They're the ones that pay the most to investors. So when this happened, by virtue of buying these 30 to 60 days bonds, a lot of folks got interested and say, well, why do I need to buy anything else if I can make 5.5% on these CDs or money market funds that are paying 5.5%? And they start looking and asking, well, does it make sense to still hold bonds or still hold stocks when I can get 5.5%? And my answer is that you have to have a financial plan, and that financial plan might have some needs there over the short term where these are absolutely fine to have. Would I change the whole bonds or stock portion for this? And the answer is I wouldn't. I would just follow the plan, but I would not change the bond funds for these CDs and money markets. Why? The first reason, Jeff, is because these bond funds, these CDs and money market funds, they buy bonds like everybody else, but they have to buy only 30 to 60 days bonds. And the thing is that once that bonds reaches that maturity at 30 or 60 days, the question is, at what rate will that CD or money market reinvest that principal? Well, whatever the rate might be 30 to 60 days from here. Is that going to be 5.5%? Who knows? Some people are saying that these higher rates at the short end were because the inflation was high. When inflation goes down, perhaps they're not going to be as high. So to me, be aware that you're not getting 5.5% for the long run. This is only for 30 to 60 days. What you get afterwards, who knows? So you got to be careful. It's not a long-term solution. The second thing is that a bond fund absolutely has the ability to buy the same short-term bonds. And we do it in our bonds. If you get paid more in 30 to 60 days, go buy those bonds. However, the bond fund retains the flexibility to perhaps go to 1 year. If you have a 1 year bond fund, it's up to 1 year, so you can buy the shorter term. But as interest rates perhaps go back to the more normal shape, the bond fund would have the flexibility to go buy the 1 year bonds, whereas the CDs will not. It will just be stuck only on 30 to 60 days. And that's the reason that for the longest time, nobody was interested in CDs and money markets, because they're buying at the low end of the curve, which was the lowest paying one. So why give up that flexibility that a bond fund has just to go buy the CDs? So number one, it's not a long-term solution. It's 30 to 60 days. After that, who knows what you're going to get? Number two, you lose the flexibility to move up when interest rates change. And number three is that we saw that when interest rates change, a bond fund sees a pop in value of the NAV, the net asset value. And last year, in 2 years ago now, in 2022, we saw the drop, and people took that beating. Now, why don't you stick around for the time when it might actually pop in value? And you're going to see that with a bond fund, but you're not going to see that with a CD or a money market fund. So, long story, Jeff. I think in some cases, based on your plan, CDs and money market funds might have a role. Would I replace all of them, all the bonds and stocks with this just because you make 5% over the next few weeks? No, I'm not sure that's the right strategy. And even if you look last year, I mean, the stock market delivered 26% returns, the S&P. These money market funds are 5%. So people say, well, I can get 5%. Great. But what about the extra return that you get by being invested in stocks?
Yeah, again, not for the long run. Yeah. Good. Well, we're coming up on time. Just before we wrap, any other thoughts, words of wisdom?
Yeah, I mean, one of the questions that I've been getting lately is, okay, so it's the beginning of the year. What should we expect in 2024? What's going to move the market? What's going to happen to the market looking ahead to 2024? And there's certainly a lot of things that people are pointing at. You have the Federal Reserve and the interest rates. You have an election. You have a lot of things coming up. And you still have conflicts in the Middle East and in Europe. So there's a lot going on. And one of the things that I tell folks is that all of these are things that are expected. And everything that is expected and known to market participants, they tend to be incorporated in the prices today. So nothing that is expected today will move the prices tomorrow. So when people are making a forecast about the future, about 2024, keep in mind that all of these things that they're regurgitating, they're known to every market participant out there. And if they were to come to fruition, these expectations will not move prices. The only reason that the markets move is because of unexpected events, things that are not known today. If you're, January of 2020, nobody had a clue that we're going to be through a global pandemic and we're going to all be stuck at home. And that's what moves the market. That was unknown and unexpected. When you had the Russians invading Ukraine, that was unknown and unexpected. You can point out to all of these things that are happening that are just unknown and unexpected. Those are going to be the things that will move the market in 2022, not something that's known today. When people regurgitate all these things, they're going to happen in 20, that's known and priced in. What's going to move the market is something that is unknown and unexpected. And because of that, I think it's a fool's errand to try to predict what's going to happen in the market. But there are some things that people should know. And the thing that they should know is that the markets really they do tend to reward discipline, and you have to give markets some time. And they will fluctuate. For sure, they'll fluctuate. But the more time you give the markets, the better the odds that you will see good results. And I'll wrap up, Jeff, because a while ago, a few months ago, I had this invitation to present to an investment club at a retirement community. So the advisor kind of had a relationship with them and asked me to come present. And I asked, well, what do they do? It's a retirement community, and they do investments. So what do they do? So I get a better sense of the audience. And well, they told me that what we do is we watch the market and we go play tennis. So I thought, like, okay, so how do I convey to those folks these ideas that I just mentioned, that markets are choppy, but the more time you give markets, the better the outcomes you're likely to see. And when you look at the statistics, there's some really interesting statistics of the market, that if you look at the S&P 500, the U.S. Stock market on a daily basis, what you see is that roughly over the past 50 years or so, roughly about 53% of all trading days in the market are positive, meaning you make money, and about 47% are negative, where you lose money. So it's a bit of an interesting thing because it's a split between positive and negative days. And it's not obvious that any given day you're going to make or lose money. It's a flip of a coin. And you got to be ready for that. And that's what I expect is going to happen in 2024. However, if you watch the market on a quarterly basis, let's say you wait for the quarterly statement instead of the daily watching of the news, what you see is that historically over the past 50 years, 71% of the quarters in the market have been positive and only 29% negative. So simply shifting your time horizon from watching the market daily to waiting for the quarterly statements, you've kind of improved the odds. You're a lot more likely to see a positive quarter than a negative one. And if you now wait for the annual statements, what you see is that about 78% of the time, historically in any given year, the market's gone up and only 20% down. So the interesting thing to me, Jeff, at that point is this idea that markets are choppy, but the more time you give them, the more likely is that you'll see positive outcomes. And then I thought about tennis, and I like tennis. And one of the folks that popped to mind was this gentleman, Roger Federer. He is, for folks who might not be familiar, he's arguably one of the all-time best tennis players, if not the best tennis player of all times. And I wanted to know, like, when you look at Roger, how did he get to be the all-time best? So I looked at the statistics of the points that he won in his career. And what's fascinating is that Roger Federer won roughly 54% of the points that he played, which is pretty stunning to me because this is not an average player. This is the all-time best. And the all-time best loses roughly half the points that he plays, which is stunning. And in order to become the all-time greatest, you don't need to win every point. You just need to play all of them and perhaps win the big ones. But if you give Roger some time, what you see is that he wins about 75% of the sets that he plays. And if you give him even a little more time, he tends to win. I mean, he won in his career about 80% or so, 81% of the matches that he played. And I thought it was so interesting because these numbers line up quite well with the market as a whole. If the market drops about 47%, it wins 53% of the time it goes up. So if the market drops any one day, don't panic any more than if Roger Federer lost a point. You're not going to pack your bags and say, oh, he lost a point, he's done. No, give him some time. The way that you become a champion in tennis or a great investor is by being disciplined, staying with it, and playing all the points. So I thought it was quite interesting that in order to be a champion or a great investor, it's not about winning every point. It's not about going up in the market every day, but it's about sticking around, playing all the points, and give yourself better odds by giving it time.
Fascinating. Yeah. So Apollo, we'll need to wrap here. Really appreciate your insights. For those participating, thank you. We had a few questions that came in near the end. We will get back to you directly on those questions. We'll also take into account any feedback that you're willing to provide us for future webcasts. And our next webcast, quarterly webcast, is scheduled for April 10th. You'll be receiving invitations for that in weeks in advance of that. And again, appreciate you participating, and we'll wrap it up here.
Very fun. Good seeing you.